Good morning. Welcome to the Brew. So today, Thursday, Traders Workshop with Jason and Mark, we're going to tee up something called Boomer Candy. Unbelievable concept. We're going to break it all down and figure out what's going on with this new ETF product. So let's get right to it on the opening bell. Hey, what's happening?
Lex, how you doing?
I'm doing well, thanks. Good morning. Good morning. This is going to be interesting. The Boomer Candy. So we should probably get right into it, I think. Only because, first of all, what the hell is Boomer Candy? Boomer referring to the baby boomers, I'm assuming?
Yeah, we're referring to you, Lex.
I'm at the tail end of the baby boomer.
Oh, are you?
Yeah, very tail end. I was the last year.
Oh, wow.
Of a baby boomer. What's the one behind me? The Gen X, millennials or something like that?
Gen X.
Yeah, Gen X.
Oh,
so you'll provide unique insight into this because a Gen Xer and a millennial have no idea what all these boomers are gobbling up.
Right, exactly. Apparently, everyone's gobbling the Boomer Candy. So here's what I think we should do. This is a newer term, right? Very cute, catchy. Let's find out how we got here. Let's give some opinions on how we got to Boomer Candy. What market environment caused this to happen, do you think? Anyone want to tee that off? Don't all jump at once.
Yeah. So typically in retail kind of circles, like for pensions and there's always a market for low risk investments that can yield some returns. A lot of times there are in the past it was like diversification or like a 60-40 kind of fund where 60% of the assets went into equities, 40% went into bonds, because back then typically equities and bonds shared the same liquidity. So if one went up, the other went down. And as long as economic growth continued, you would realize certain gains. As time evolved and markets became more liquidity fueled, bonds and stocks became positively correlated, which was great for 60-40 in good times, but it lost its edge. It's lost its risk to return it lost the diversification needed, right?
Why? Because
the market became more liquidity driven.
What? But also interest rates started skyrocketing and bonds got hammered as a result.
Yeah, I mean, yes, but when the Fed started lowering interest rates, bonds went up as stocks went up.
That's
so 60-40 portfolios, like the point of them, which was diversification to mitigate risk, all of a sudden lost that concept, right? It like lost that, and so equities are usually considered more risky, and we started seeing these target funds, right, where you target a certain retirement date, and the later the target, 2050, 2055, whatever, the more balanced you were toward equities, right? Because the thesis is equities always go up in the long run, and you can survive more downturns, even though they're more volatile than bonds typically. You could survive more downturns if you're young, right? You can and you could retire at all-time highs or whatever. Or at least Mark can, right? So, but bonds were considered less volatile, so you'd allocate more to bonds. These low risk kind of investments are great for 401k plans or things like that. But when they get to a point where bonds and stocks are positively correlated because the market is more liquidity driven from like Fed action, monetary action, etc., as opposed to growth driven, then new kind of low risk investments were needed, right?
Okay.
In steps options. Options are by their very, like, the product is supposed to be an insurance on your portfolio, which is technically like a low risk thing. So, right now there are a lot of like pensions, that use options. They kind of, use puts to hedge equity costs and, things like that. Health insurance do the same thing, annuities, all these kind of low risk investment. Now, Boomer Candy is essentially that, but without like all the fees and stuff like that. It is buying a put at the money, buying, it's a fully hedged underlying position. Let's just say SPY or something. You buy 100 shares of SPY, buy the underlying put at the money, and then you sell a call to pay for it. That is
sounds like a collar. Sounds like a collar.
It's a collar.
Okay.
But because right now interest rates have skyrocketed, the row on options allows for some space there that you can gain without any risk because you're buying the at the money put.
Okay, so let's just stop for a second. Okay, this is great. So what's happened then when interest rates go? Mark and I are going to argue about this in a second. When interest rates go up, what happens to the reversal? It gets better, right? That means calls go up and puts go down. So hence we can buy puts and sell more expensive calls in these higher interest rate environments. Yummy. Don't argue, Mark. Please.
No, I'm not. We might argue about where the delta of at the money is, but what happens to at the money. But I think you highlight the best point is that, like, these are just an interest rate play, right? Like, this is not. This is ultimately what most is driving Boomer Candy is just interest rates. Whether you do the kind of collar that Jason's talking about, whether you do like the structured product setup with T-bills and call spreads, like this is all just playing with that interest, and they mostly exist because we're in a positive interest rate environment because the forward value of money for the next 360 days actually has value today. So you're just trading that value into something else, whether it's a gamble, whether it's protection, whether it's whatever.
So, but does the Boomer Candy have to be constructed by the end user, or is it something? Is it a product that they can just consume, and it does all those things? It's already inherent in the DNA of the ETF. Do you understand my question?
Yeah. So you're saying, do you have to build it yourself, or does somebody build it for you?
Correct. And I can just go buy it off the shelf. Because I fit perfectly in a clothes, so I don't need custom stuff. I'm saying.
So
the candy is the stuff you buy off the shelf. The vegetables are what you go to Adayam for.
That's right, Adayam.
Yeah. So I mean, it's pretty soon. Very very soon. We've been Adayam. My RIA is going to be offering Boomer Candy. We're not going to. I probably won't call it that. We'll call it controlled risk funds, where you have various like risk thresholds. You can. If you buy a put that's 2% down, then you can sell a call and try to realize more upside. Or you can do a spread where you can buy at the money put and sell 5% down to take 5% risk off, and then you have a higher call. And it's gonna be automated, and this will be packaged. I do know that there are other funds. I think Mark said BlackRock offers something like this. I know the famous one is the JP Morgan JHEQX or whatever collar, where they do it on a whole portfolio off of SPX. And so there are, that's the kind of most famous, you could call it Boomer Candy, even though it's not the technical at the money put. But yeah, I mean, there are there are places you can get this. But you could also construct it yourself if you're a do-it-yourselfer. If you buy, if you want to just use SPY, if you buy at the money, SPY, and you buy 100 shares at the money put, and then you could sell a call 1 year out. I think right now it's at like 8-9% max gain.
So yeah, so just so everyone's kind of clear on this, and let's make sure we get it right. So what this boomer candy is essentially doing, right? It's providing a return to the boomers, and they use it because these are the retired people who are getting some sort of fixed income. We're capping a downside, right? So by buying this put, we are picking a level down that we are capping it or stopping it.
Mm-hmm.
Right. So we have limited downside risk. We do have downside risk, though. Let's be clear on that. But it is defined by, technically what put we're going to buy in this case. Right. So you could pick that percentage. We're also capping the upside because we have to finance that insurance policy by selling something. So we're also, stopping the max profit we can make on this as well. But the difference between those two is going to be some sort of return that you as a DIY do-it-yourselfer, right, is going to compute. Is it 8% up, 3% down, 10% down, 20% up, that kind of stuff, right? And it sounds like we can be very creative with the way pricing exists in the options markets to do this, to make this kind of sugary boomer candy. And sugary, how much sugar do you want, right? As they say.
Right. Or, how much tempted are you? I mean, if you buy an at the money put and you finance it with a call, the difference between that is the options pricing of the value of money. So I don't want to say it's like risk free because interest rates can go up and then you're kind of losing, in that sense.
Yep.
However, you're not going to lose like money, so I think like there are, this definitely has a market. If you're a day trader type person with a high risk threshold, this isn't really the product for you.
Right.
But if you're, nearing retirement, you want to preserve capital, you have a plan on to when to retire and you have enough money. What more do you need it for? I mean, like you're not going to, sit there and try to gamble it all on black, right? Unless you're Lex.
Is there something wrong with that?
Lex's investment strategy is more lottery tickets. No, I mean, so I guess what I'm saying is you can structure it in such a way that you could preserve your capital with some upside. And that, that's good.
Right.
That's very suitable for quite a few investors.
So back to one of my earlier questions, and again, I am not as well versed in this as you gents are, and I'm just asking questions from the dumb person. That's me. So I know how I can construct this myself. That I get. Okay, I can do this collar with the S&Ps or the Qs or whatever I want to do. Right, whatever my underlying product is. Is there an ETF that I can purchase that is a structured type product that mimics the behavior of what we just described? Meaning, we have a capped downside, we have a capped upside, we have a interest rate in between that we can, expect. Is there an ETF? And I'm looking at maybe the First Trust FT Vest U.S. Equity Buffer ETF. Have you guys heard of that? It's FOCT. And it claims to buffer the first 10% of the S&P's decline, but participate in the first 19% rally over a 12-month period. So that sounds like an ETF to me that I can go buy, and it does all this stuff for me. Does that bring me?
Yeah, these ETFs are definitely the candy. I mean, this concept has existed forever, but the packaging and distribution of them via these like exchange traded products, that's like the candy that is like advisors are doling out, people are buying individually. Like it's like everything neatly wrapped up in a bow, so you don't have to worry about strikes and time value of money or anything like that. You just get these like, shiny looking breakpoints to, buy with one click.
Right. Right. Do you guys, what's your, your gut on this one? Do you like this sort of investment for the demographic of who it's kind of targeting, the baby boomers? Is this, I mean, to me, it seems like kind of a nice little product for that group. I don't know. Maybe I'm missing something.
Oh, I think it's fantastic. I think the concept is amazing and like it's incredibly useful. Like sort of like we talked about last week, right? And like a high rates, a week ago it was low vol environment. Now we're at a whopping VIX 16. But like in like this environment, I think they're incredible products. My beef with the candy is it's got too much sugar, right? Like, you want like 70 bips of fees on these things. Like I think BlackRock's only 55 bips on their product. Like that's a chunk of change. So not only do they get you there, like you got to pay for everything, but they also like have a much lower return compared to what you could actually get in the listed options.
Right.
So like I'm looking at, one of the other big ones is these innovator ETFs. They got 135 million bucks in there, one expiring in 6 months, but they shave 80 bips off the max, cap. You could get 5.8% in the market today with a call spread with compared to your interest money, whereas they're guaranteeing your 100% and only giving you up to 5%. Gotcha. So like you're paying 79 bips of fees, you're cutting 80% off or 80 bips off the top, 80% off. But like, that's a big difference. That starts to make it worth it to do it yourself. Like, you're talking pretty quickly material money.
Yeah. So okay, then I'm glad you said that because that's what I was going to ask next. If you're going to get feed to death on these ETFs and the structured product, I'll call it for lack of a better term, you're right. Why wouldn't you do it yourself? Assuming you understand what you're doing. I mean, that's a big assumption, I suppose.
That's the issue. Is they're preying on people who don't understand what they're doing. I mean, most of these the demographic that this is meant for is not for people who sit there and click and trade every day or have an understanding even of options. Right. The only thing they hear of, usually options kind of have a reputation of being more risky. So, things like derivative products scare a lot of people. Right. And that fear is kind of what is being preyed on. I think like things like annuities, though, are worse as far as fees go. Or made like whole life insurance kind of things, like fees for that are very hefty. So I guess you could say we're trending in the right direction.
Okay. Right. No, I think you're totally right. I think the alternatives are even worse. And like the ETFization of this strategy is going in the right direction. I totally agree with you there.
Yeah. Okay. So, but
actually, can I throw a third wrench in this?
Yeah, throw a third wrench, and I have a question for both you guys, since you're in the advisory space, sort of. So, okay, go.
Okay.
I was going to say the third thing, and this is like a minor concern. Like, I think the number one thing, what I don't like about the ETFs is that they don't give you the full dimensions of that return, that you can actually do better. Fees, okay, fees are fees, right? Like, you're going to pay Jason or I fees if you were going to do this too, right? Nothing comes for free. So, but like, if you really want to get into the weeds, they also trade these via flex options. And so that's a much less liquid market than what you get in listed SPX, for example. Some, I believe, do go into like the underlyings, but a lot get traded via flex. And while it's not like an enormous amount of money, you are giving up some extra edge to trade with someone in a non-standard expiration that's going to expire to perfectly align with the issuance of your product.
So relative to the flex, which is a custom product, let's call it, right? How does your typical retail person get engaged in a flex trade, would you say? Or I
don't believe retail really can.
Yeah, I don't know.
Or good, right? Like there's so many listings out there. Like, give me a good reason why you need like a more precise expiry than what we've got in any of the top 200 issues.
But do you think, though, if the more sophisticated, I mean, maybe it's not even retail, maybe it's a little bit more institutional, do they push out, hey, I want to do, the S&P 500, 5% down, 20% up, collar, give me a market on 80 days out or 200 days out for that matter? You think that's going on?
Oh yeah, because like I'm looking at BlackRock's caps right now, and like their cap asset value is like the 574.70 strike.
Okay.
So like I'm sure we could dig into the OCC, trade tape and like find some flex for 574.70. And like that wasn't good enough to have one 30 cents away or 30 cents below, whatever. Yeah. But like they had to call up a dealer and say, hey, can you give me this market? And it's probably pretty good, right? Like markets are really liquid. There's some competition for that. I don't mean to exaggerate this, but still is less liquid than like what you get in the actual listed contracts.
Okay. Well, here's my question to you before we head out. You two guys. So, I mean, you essentially registered investment advisors, right? Safe?
Yes.
Okay. Not that you're going to offer this, but if you were, could you guys create, and I'm going to call it a structured product, which isn't the right word necessarily because it's not truly structured. You have to put the components together. But could you recommend, percent down, percent up sort of structures with time in terms of using the correct expiry so that beginners could understand this? Say, hey, here's an idea. I'd buy, I'm making this up. I'd buy the January of 2025 XYZ put and sell the call. That's going to be, a structured of X percent return for you, blah, blah, blah. Maybe consider it at these prices.
I'll do you one better. I have a free tool on my website that you can go and play around with exactly what these buffer levels are for any product that exists in the world.
Mm-hmm.
So go to demothetape.com and you will find, you can do interest rate products,
was that
the level of your call spreads, your knock-in, your protection levels, you can do upside downside swaps, you can sell puts to buy calls.
Well, that's at harvested.com, harvestedfinancial.com.
It's not on my main website, it's on my analytics website.
Wait, that's a plug. Thank you.
That is a plug.
Valen, do you want to plug? I'll give you a bell.
Well, I mean, we did add damn funds before.
Okay. I love it. So I think that, by the way, I think that's great that you guys are doing that. I think that's helpful. I think, the typical retail person who wants to participate here without paying all those fees and just consuming it off the shelf might not understand, which strikes to choose and that sort of thing. So if there's any sort of tool that would get them to the correct place based on their, their needs relative to income, I think that would be awesome. So, just a thought. Don't get excited.
I'll just give my plug again. Demothetape.com.
Demothetape.com. We're gonna have that in the edited version of this when it's done. Demothetape.com. Okay. All right, good.
Yeah, I mean,
what's the bad news about this, by the way? Is there bad news? I know we kind of touched a couple things before we go. Is there any horrible thing here that we're missing besides interest rates going the other way and volatility doing something?
Yeah, I mean, if interest rates go up, then you kind of miss out on the time period that your spread is.
Yep.
The other bad news is this is not going to get you rich. I mean, this is going to preserve your capital. I wouldn't say it's necessarily bad news. It's just if you have a high risk tolerance, you're going to be bored by this, and this is probably not for you.
But this is an investment strategy, in my opinion. It's not a trading strategy. It's something that you do. You put part of your money to work doing this. Maybe not all of it. So that's the case. What happens in the event of you're getting toward expiration of whatever you've chosen here, right? Mm-hmm. How do you roll this? Obviously, you're going to keep the underline, and you got to roll the put and the call. Right. So it's just a simple roll. You got two legs to roll and you've got to pick your new levels in time. Right.
Mm-hmm. You just rolled your put. Like if say you're doing an at the money put, you just roll it to wherever the current price is.
Yep.
And then you roll the call to whatever strike pays for the premium of the put.
Gotcha.
And you sell the call by the at the money put.
What do you think is the optimum expiry DTE, dates expiration, that people should use? Is there one?
So if you're doing this yourself, the most optimum all the time is the closest to expiration that you can get. But when you start talking like a 1 day kind of thing, you're not going to get any return.
Yep.
You're going to get like just a couple decimal points, and that becomes high maintenance.
Sure.
So it's personally, we're gonna, like when Ad Diem Funds is doing it, we're gonna do it quarterly.
Okay.
But the reason why more frequency is better is because it will always protect you from downside, but you will capture any day that there is an upside. You'll capture that piece, or any month or any quarter or whatever.
Sure.
I do think that because you don't want to go 1 year. Let's say you bought, let's say you had something in May you realized full gains in June because we just went up, and then over the past week you just lost all your gains.
Right.
So the frequency does matter, but it also work-life balance matters too. You don't want to sit there every day buying a put and selling a call.
So you could see then, based on that answer, you could see someone picking the serial expiration, let's say, and SPY, and the serial being the third Friday of the month, that one. So that's every 30 days, sort of, right?
Yeah. 30 days. That's pretty good. That's I mean,
Mark,
that's
anything
very
to add there from
frequency.
your point of view on that stuff, on time and all that kind of good stuff?
Yeah, I think that's a great point about like the balance of this whole thing. I like, this is like a 90, 180, 360 kind of thing. One of the questions I often get is like, should I roll this early? And like, there's not really any point to rolling early. Like if you have a 90-day trade on, you wait until the end. Like whether it's a regular collar, whether it's a put spread collar, like all you're doing is like market timing. If you start like rolling stuff around, like then you might as well just be day trading. Like, so like usually there's the type of structure that you set up and you let it go until the end.
Yeah.
Unless you're way up or way through, and then you're still market timing, but that might be a decision because something's changed.
This is what I call the hidden portfolio, meaning I put it in the one that I don't look at, in the little black box. And then my day trading stuff, my 0 DTE, that's a different story. I can lose with the best of them there. That was a tough day yesterday, by the way.
Was it? Yeah, I mean, yesterday was interesting, right?
Well, we never really bounced from anywhere. We just grinded down. We opened down and straight. It was like we're digging a hole in the ocean.
Yeah, Volland was showing that like 0 DTE option traders were not prepared. But all the way down to I think it was like 54.45. We identified as like that's the place where dealers will start gamma hedging. And if you look at yesterday's tape, right at around 54.50 or so, you got that 20-point gamma hedge in like 5 minutes. And then you bounce a little bit, and then at the end of the day,
that was it.
So I mean, it was yesterday was interesting, and also the fact that it was mostly tech. Made me think that it was yen related.
Well, maybe for another time, the yen related. Mr. Yen.
10:30.
All right. Well, very good. That was interesting. The boomer candy. I like it. Very cool. What else? We good? I think we're good. We good?
Happy trading.
Good.
Okay. I think I'm good. I think I'm really good. I'm looking forward to the weekend, even though it's 2 days away. But, volatility's kind of poked its head up a little bit. I like that. Seeing a little higher premiums. So I will be heading to the machine after we get off here and start putting things out there. Got a couple earnings plays I've got to get out of too. Love.
Great.
Southwest Airlines. I got to go check that one out too.
Oh, didn't they just got rid of they now assigning seats.
The festive seating. I flew up Southwest once in my life. When I realized that you don't get an assigned seat, I'm like, whoa, hold on a second. What do you mean?
Yeah, you got to check in early.
There's none of that for me after that little episode. No chance. No good.
It's a stock good enough to invest in, though.
Good point. I'm not sure about that either yet, but they are changing their model, which has been around for 45 plus years or something like that.
Yeah.
So interesting to see.
Now actually,
American had some bad, little tougher time as well. I think they got hit a little bit on their earnings call as well. So
yeah, it's amazing considering how many fees I have to pay to sign in my luggage, and
it's unbelievable. It's getting like, I don't want to name an airline I don't like. It's getting like this particular airline that charges you to basically to get a bottle of water and go to the bathroom almost. That drives me nuts. It always looks good when you first sign up until you pay all the fees and you're like, why didn't I use my legacy carrier? It's about the same, right?
Right. It's just ridiculous.
Yeah.
How many fees you get for baggage and,
All right, boys. We'll have a good weekend. Great seeing you. Jason at vol.land.
Yep.
Mark, harvestedfinancial.com. Check him out there. Always check us out on hub.tradier.com. And Mark, you got a new one. Do the demo one again. I forgot it already.
Demothetape.com.
Demothetape.com. That's where you can find these cats. And on maybe next week's show, if you guys get us the assets, we're going to have a cool little graphic that comes on for your two products. Going to be neat. Wait till you see it. Down?
Excited.
All right, boys. Have a good one and happy trading. Mark, you say it because it's your line.
All right. Happy trading, everyone.
All right. Have a great one.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.